Hello. Very good evening, everyone. Hello. Very good evening, everyone. Is it audible, everyone? Can you first respond? Is it audible or not? Yes, sir. Very good evening, Saket, Lokesh. Yes, sir. Yaswant. Yes, audible na. Prachi, audible. Yes. So, are you all ready for RTP November 2023 discussion? What I have done that I have divided this entire RTP discussion in four parts. There are 20 questions given in RTP. So each day I will take five questions. Five question means first day I will take one question number one to question five. Is today I will take question number one to question five, and then next day once again five question, then five question, then five question. Correct now. So it will be easy for you to also give some time on RTP. And this time what happened, RTP they have given good qualities of questions. Means all the questions whatever they have given are of good quality. Most of the questions are new questions. So of course you should once do the entire question whatever given RTP for this particular exam. I don't know whether this same question will come in exam or not, but of course whenever we say RTP, RTPs are always important from examination point of view. This you also know, we also know, everyone know that RTP's question are always important. One question directly may come from RTP. Got it? Yes, sir. So can we start a discussion if you are ready? Can we start a discussion? Yes, sir. The first question given is for India's 103 business combination. Business combination chapter. Let us read the question first. Mini Limited is a manufacturing. 1 minute. Yeah. Mini Limited is a manufacturing entity in the textile industry. I hope you all have downloaded the RTP November 2023, because of course you need to take a photocopy of that. I have the RTP with me. You need to also have RTP with you all. Got it? Yes, sir. Yeah. So Mini Limited is a manufacturing entity in the textile industry. Mini Limited decided to reduce the cost of manufacturing by setting up its own power plant for the captive consumption. Means they want to set up its own power plant. Okay. As per the market research report, there was a non-operational power plant in the nearby area. Hence, he decided to acquire that power plant, which was having a capacity of 80 MW with all entire labor force. So they want to acquire one power plant which was having a capacity of 80 MW along with the entire labor force. Now, if you remember the business definition, what is the meaning of business definition? Business is an integrated set of activities and the assets which are conducted for generating revenue, means which can be conducted for generating revenue. Correct now? Understood? Now, for meeting the definition of business, there are three requirements. One is input, then process, and then output. And the process must be substantive. One of the condition of meeting the definition of business, that whatever process you have acquired must be substantive. And the process becomes substantive when the entire workforce are also acquired, means skilled workforce are acquired. It is given that along with the entire labor force, it is an indication that whatever you have acquired that will meet the definition of business. Means if it will not meet the definition of business, then it will be an asset acquisition. In that case, India's 103 will not be applicable. Understood this point? This power entity was owned by another entity, Max Limited, Mini Limited approached Max Limited for the acquisition of 80 MW power plant at the following terms. Correct? Mini Limited will seek an independent valuation for determining the fair value of 80 MW power plant, value of other non-current asset acquired, and non-current financial liability assumed is 11.10 million and 32 million respectively. It means they have not given the fair value of power plant, but they have given the fair value of non-current asset acquired, other non-current asset acquired, and non-current financial liability assumed. Consideration agreed between both the parties 51 million. So PC purchase consideration is given the question. Thank you very much. PC is given the question. Both the party has agreed to the terms enter into the agreement on 1st April 2001 with immediate effect. So both the party has agreed to the terms. Okay, sir. Thank you very much. Due to unavoidable circumstances, valuation could not be completed by the time. So what they are saying, due to unavoidable circumstances, valuation could not be completed by the time once you need to what? Complete the business combination accounting. Max Limited finalized its financial statement for the year ended 31st March 2001. Max Limited annual financial record Max Limited annual financial statement record the fair value of 80 MW power plant at 46.90 million with a remaining useful life of 40 years. So Max Limited has recorded a fair value of how much? 46.90 for the power plant. Max Limited also has a license to operate that power plant unrecorded in the books. So there is one license to operate the power plant which is not yet recorded, which is not recognized in the books of Max Limited. As on 31st March 2001, it has a fair value of 5 million. 6 months after the acquisition date, Mini Limited received the independent valuation which estimated the fair value of 80 MW power plant as 54.90 million. So 6 months after acquisition date. So what is the acquisition date? If you see the acquisition date in the given question was how much? So both the party agreed terms enter into is 1st April 2001. So as for the question, the acquisition date is 1st April 2001. So once they have acquired it, after 6 months, they got the valuation report and that is 54.90 million. CFO Mini Limited want you to work upon the following aspect of a transaction. Determine whether transaction should be accounted as an asset acquisition or business combination. So of course, can I say it will be an asset acquisition because it will not be an asset acquisition. It will be a business combination because it will be the definition of business. You should write down the business definition and the criteria for business combination definition criteria. So once you have read that, you can write down the definition of business. Yes, sir. Calculate goodwill or gain on bargain purchase due to above acquisition and pass necessary journal entry in the books of Mini Limited as per Ind AS 103 and prepare the balance sheet as on the date of acquisition. Can I say this is very easy? Point number B and point number C is very easy. You can do it just very easy. And determine whether any adjustment is required in case of valuation received subsequent to acquisition. If yes, pass necessary entry in the books of Mini Limited. This point number D is related to measurement period. Related to measurement period. I hope you remember the concept of measurement period. Correct. Now, Ind AS 103 has given the concept of measurement period. What is the measurement period? If the initial accounting remain in, if the accounting for business combination is not completed by the end of reporting date, by the end of reporting period, then Ind AS 103 has given a maximum measurement period of 1 year from the date of acquisition. In that measurement period, we can receive the new information which may be required for the facts and circumstances existing on the date of acquisition. And taking that into consideration, we can do some adjustment in initial accounting on a retrospective basis. That is the measurement period. But from my point of view, there is some error in the question. The error is what? They have given the agreement date is they have given that agreement date is 1st April 2001. Means if the date of acquisition is 1st April 2001, the date of agreement is 1st April 2001 and the valuation report received within that year. So can I say for this particular financial year we have received the information within the year only. So from my point of view, this date of acquisition, if you want to apply measurement period concept, the date of acquisition will be 31st March 2001. So there is some printing error from my point of view. Date of acquisition should not be 1st April 2001. The date of acquisition should be 31st March 2001. If the date of acquisition is 31st March 2001, then only the concept of measurement period will apply. Otherwise, the concept of measurement period will not apply. I hope you are understanding. So we'll make some changes in the question, because of course if the same questions comes in exam, of course you can't modify the question. But to explain the concept, I am assuming that this is not 1st April 2001, this is 31st March 2001. Just try to understand what they have given. He on 1st April 2001, this is the date of acquisition, and the financial year end will be 31st March 2002. Correct now. If the financial year end is 31st March 2 and 6 months, within 6 months, if you are receiving the valuation report, of course you can do correction in this accounting in this year only. Correct now. So of course from my point of view the question is not correct. Question is not correct. The date of acquisition should be 31st March 2001, and to complete this accounting we require valuation report which was not received before which is not received before the financial statement is approved. So suppose this is the date of approval and we have not received the valuation report, and valuation report is received after 6 months. Correct now. So of course this become the measurement period. 1 year after this the measurement period, the concept of measurement period will be applicable in this case. Correct. Understood this point? Hold for 1 minute. Now now have you understood this much? So from questions point of view, if we consider this 31st March 2001, then only the question will become correct. Understood this point? It, the date of acquisition is 31st March 2001, and after 6 months we have received valuation report. So once the valuation report is received, then we can do adjustment for the initial accounting which was completed on some provisional basis, correct? So let me take all the information given in the question. Yes sir. So what is the purchase consideration given? Let us first calculate what? Goodwill or gain on bargain purchase. This will be on 31st March 2001. Means as per the question it is 1/4/2001, but from my point of view it should be 31st March 2001. Got it? Yes sir. 1 minute. Now what is the fair value of power plant has been given? Power plant fair value is given 46.90. Then other non-current asset is given how much? 11.10. And there is one non-current liability. How much non-current liability they have given? That is 32 minus, and there is one intangible asset also. Intangible asset. So can I say even though intangible asset was not recognized in the books of acquirer, it can be recognized in the books of acquirer if it meet the definition of intangible asset. So if it meet the definition of intangible asset, of course it can be recognized in the books of acquirer. So how much the fair value is given? 5 crore, 5 millions, correct? What is the total fair value? It is 46.90 plus 11.10 minus 32 plus 5. How much is coming? 31 millions. So this become fair value of INA. What is the PC given? Purchase consideration is given 51. So what is the goodwill? Goodwill become 51 minus 31 is 20 million. Very simple. What journal entry you will do? Journal entry. Journal entry will be power plant account debit how much 46.90. Other non-current asset account debit is 11.10. Then there is one intangible asset account debit 5 million. 2, there is what non-current liability how much 32, and 2 PC. Let us assume it has been paid in cash. Nothing is given, so of course you can assume that it is paid in cash. So how much it is? PC is 51. The difference will be goodwill, and goodwill is coming how much? It is 20. Okay, super simple journal entry. This journal entry, and with this journal entry, can I say you can prepare balance sheet? So while preparing balance sheet, your property, plant and equipment will increase by 46.90. Your other non-current asset will increase by 11.10. Your intangible asset will increase by 5. Your goodwill will increase by 20, and your non-current liability will increase by 32, and your cash will decrease by 51. And balance sheet will tell you, so balance sheet can be prepared very easily. Only one point, what they have asked in the fourth point about the measurement period. So can I say if on 31st March we have recognized power plant by how much 46.90, and because of that reason goodwill we have recognized at 20. Now after 6 months, what is the fair value? What is the fair value we have received? The fair value of this power plant is how much? Is given how much given? It is given 54.90. So 54.90, so it means 54.90, so it means how much increase? How much increase? It is 54.90 minus 46.90, it is 8. It will be increased by 8. It means on 30 means we need to do some retrospective adjustment. We need to do some retrospective adjustment. We should increase the power plant by how much? 8 million, and we should decrease the goodwill by how much? 8 million. So what journal entry will do? Will do power plant will increase by 8 million, and we will decrease goodwill by 8 million. Understood this point? This point have you understood? And can I say with this particular journal entry, the depreciation of current year will be also adjusted for 8 million. So on 8 million, what is the remaining useful life given? If you see, the remaining useful life of this power plant was how much? 40 years. It's giving remaining useful life is 40 years. Correct? So 8 million divided by 40. How much? It is 0.20. So it means you need to pass my journal entry for depreciation for 0.20 for the entire year. For the entire year, but they have done in the solution, they have done only for 6 months. I don't understand why they are doing for 6 months. Correct now, but chalo theek hai na. Means of course we will do some adjustment entry for current year depreciation. The current year depreciation will be increased by what? The current year depreciation will increase. Correct now, I hope you are understanding. So with that, the journal entry will be depreciation account debit to depreciation accumulated depreciation. Understood? Have you understood? Means for the entire current year depreciation we should do, but they have done in their solution, they have done only for 6 months. Means what they have done, 8 million divided by 40 into 6 by 12. So they have done by 0.1 million. I think from my point of view it should be 0.2 million. Understood? Because current year depreciation will be adjusted. Yes or no? Correct na? Chalo theek hai, but will not fight for this. Will not fight for this. The actual journal entry retrospective adjustment entry is this: your power plant should be adjusted by 8 million, and your goodwill should decrease by what? 8 million. Understood this point? Have you understood this point? Correct? Yes sir. Now somebody has asked that how much FR revision required for first revision. How much time is required for FR revision for the first time revision? Just try to understand. If you are doing FR revision for the first time. Means you have taken the classes and you are revising FR for the first time. The minimum number of hours is 200 hours. 200 hours is minimum required for revising FR for the first time. Subsequent revision may be done in 100 or 120 hours, but first time revision minimum to minimum 200 hours is required. Because somebody has asked this question, Prachi has asked this question, therefore I am replying this particular point. Understood, Prachi? You can ask me some other question also. Any other point, whatever you have in your mind, you can ask me. Correct now, so that I can help you in your other personal questions also. Got it? Yes, sir. So question number one done. Can we come to question number two? Yes, sir. We can come to the question number two. I'm not drawing the balance sheet. Balance sheet is very easy. Come to question number two. This is also a good question. Infotech Global Limited, as standalone entity, has a functional currency of US dollar and need to translate its financial statement into presentation currency. The following is the draft financial statement of Infotech Global Limited, prepared in accordance with the functional currency. You can see the balance sheet has been given property, plant and equipment, trade receivable, inventory, cash, share capital, retained earning, trade payable, loan, etc. Then statement of PL is also given revenue, cost of sales, distribution cost, admin cost. They have given statement of PL. Then extract of statement of changes in equity is also given. Retained earning at the beginning 18,000 US dollar, profit for the year 14,500, dividend 3,000 and retained earning closing balance given. Share capital was issued when the exchange rate was INR 70. Correct. Retained earning on 1st April 2001 they have given at rupees only. The retained earning on 1st April 2001. This is 1st April 2001. Means at the beginning of previous year. They have given at the beginning of previous year. As on 31st March 2002, the cumulative gain on of rupees 4,92,000 has been recognized in the foreign exchange reserve, which is due to translation of entities financial statement to INR in the previous year, which due to translation of financial statement from US dollar to INR, and FCTR is already recognized in previous year, that is amounting to rupees 4,92,000. Got it? Yes, sir. Entity paid a dividend of US dollar 3,000 when the rate of exchange was US dollar 1 is equal to 73 point. So this dividend of 3,000 whenever it was paid, the rate was 73.5. Profit for the year 2001 2002 means previous year it was $8,000, which has been translated at rupees 5,72,000, and profit for the current year is 14,500, which has been translated at 10,72,985. So you can see 14,500, this has been translated at 10,72,985. Correct? Yes, sir. This is the question they have given. For the sake of simplicity, item of income and expense are translated at a weighted average monthly rate, as there has been no significant exchange rate fluctuation during the entire year and the business of entity is not cyclical in nature. Means already they have translated, and normally we know that income and expense will be translated by using average exchange rate. So average exchange rate is given, they have given the translated amount. Relevant exchange rate are as follow. They have given, this is 31st March 2002, means opening rate of current year 73 or closing rate of last year. A rate at 31st March 2003, this is closing rate of current year. Prepare financial statement of Imported Global Limited translated from functional currency to presentation currency. Correct now. Now what is the rule? Translation rule. The translation rule is very simple, that all asset and all liability. All asset, all liability will be translated by using closing exchange rate. Closing exchange rate means on reporting that whatever the closing exchange rate is prevailing, that rate will be used. All income and expense will be translated by using average rate or transaction deduction rate. Normally they will give average rate only in the question, so we will apply average rate. And any equity share capital will be translated by using the date when it was actually issued, the exchange rate of the date when it was actually issued. Okay, so for equity share capital they have given 70. Understood? Yes, sir. Now first we need to prepare one working note for the closing balance of retained earning. Closing balance of retained earning. So let me first apply that. So first we'll prepare one working note number one. We are doing question number 2, closing balance of retained earning. Correct? Understood? What is the opening balance? This is 31st March 2003 year ended. This is 31st March 2002 year ended. So opening balance is given how much? You can see the opening balance as on 1st April 2001 is 4 lakh. We can start from here. Means this is nothing but 0102 and this is 0203. We can start with 4 lakh and then we can add profit of the year. Profit of the year. So profit is given for 0102 how much? They have given 5,72,000. So we can add 5,72,000. Add 5,72,000. And then let's dividend. Dividend of previous year has not been given, is no dividend. So this become the closing balance. Closing balance is how much? It will be 9,72,000. This 9,70,000 will become opening balance of current year. Opening balance of current year. What is the profit of current year translated? It is 10,72,985 and dividend it is 3,000 and translated by using 73.5 which will come 2,20,500. Understood? So this closing balance will come how much? It is 18,24,485. Understood? This become the first working note. Once you have done this, then the entire solution is very easy. Entire solution is very easy. Only you need to work out this. If you have done this working note correctly, then balance working note will be easy. The balance point I will show you from the solution only. Can we come to the solution? Yes, sir. So come to the solution. You can see question number 2. You can see the first working note is this only. I hope you have understood. The second balance sheet. So all balance sheet item will be translated by using what? Closing exchange rate, all asset and liability apart from equity. Equity means what? Share capital and other equity. Apart from that, all assets and liability will be translated by using closing exchange rate. You can see property, plant and equipment, trade receivable, inventory, cash. For the previous year, we have translated by using the closing exchange rate, and for current year also we have translated by using closing exchange rate. That you translation you can do. Similarly, you can see apart from share capital, retained earning, you can see trade payable, loan, etc. is translated by using what? Closing exchange rate. And share capital will be translated by using the exchange rate when the share capital was issued, that is 70. Can I say previous year balance sheet figure can be worked out? The previous year balance sheet figure is 9,72,000 which has been given in the question also. You can see if you read the question it was given only. Check करेंगे. So you can see this was given as an opening balance na. Okay. So you can see, yeah, this is the retain earning from the working note. Retain earning from working note we have calculated this 9,72,000. This will come from working note and this 4,92,000 will balance sheet figure which is in the question also. You can see the question. Question it has been given at 31st March 2002. Accumulative minute, accumulative exchange difference of 4,92,000 has been recognized. You can see this point. Understood this point? Have you understood this point? Yes, sir. Correct. Yes, sir. Now, can you say similarly we can find out a balance sheet figure from current year balance sheet and current year balance sheet retain earning from the working note we can find out, and this will be balance sheet figure. This will be balancing figure. Understood? Yes, sir. So this become balance sheet. Now only we need to prepare one what? One statement for other comprehensive income. Can you see this FCTR will be transferred to other comprehensive income? This FCTR will be transferred to other comprehensive income. So you can see they have drawn one statement of changes in equity. I can draw for you if you want. So let us draw a statement of changes in equity. Statement of changes in equity. You can see we have share capital, we have retained earning, and we have FCTR, and this become total. So what is the opening balance? Opening balance means as on 1st April 2002. Can I say opening balance of in INR? Opening balance of share capital is 35 lakh. Retained earning opening balance already we have calculated 9 lakh 72,000, and FCTR opening balance is what, 4 lakh 92,000. This you can total, then plus profit for the year. The profit already we calculated, that is current year 10 lakh 72,985. 985. However, we should add on total comprehensive income. Don't write profit to total comprehensive income. Profit or loss will be transfer retained earning and OCI. OCI. Can you see this should be the balancing figure? This we need to work out. What will be the balancing figure? Understood? And then minus dividend. Dividend how much? It is 2,20,500. So this become closing balance. Closing balance is how much? It is 35 lakh. This is how much? 18 lakh 24,485. And this we have calculated as a balancing figure from the balance sheet, which is coming 6 lakh 38,015. So how much has been transferred to other comprehensive income of current year? That will be the balancing, the difference between these two. You can see it is 6 lakh 38,015 minus 4 lakh 92,000 is equal to how much? 1 lakh 46,015 rupees. So this is 1 lakh 46,015 rupees. Understood? This become the statement of changes in equity. So this will be transferred to what? OCI. This will be transferred to other comprehensive income. Understood? Have you understood this point? So this is also a good question. Can be asked in exam. Good question. Simple question but good question. Question number 2 also understood. Let us come to question number 3. Question number 3 is a simple question, or a similar type of question is given in what ICAI study material, but let me do it. Entity A own all the share capital of entity B and control entity B. On 1st April 2002, entity A acquired a building from entity B for rupees 600 lakh that the group planned to use as its new head office. Means this will be property, plant and equipment of entity A. Entity B has purchased the building from a third party on 1st April 2001 for rupees 525 lakh. 525 lakh. At that time the building was assessed to have a useful life of 21 years and residual value of nil. On 1st April 2002, the carrying amount of building is 500 lakh. You can see 525 divided by 21. How much? 525 divided by 21 is equal to 25 only. So carrying amount will become 500 only. Correct. In entity B's individual financial statement, the estimated remaining useful life of building measured from 1st April 2002 is 20 years and the residual value of building is still nil. The method of depreciation straight line passed necessary journal entry for recording the above transaction in the books of entity B, entity A and group journal ledger. Correct now. Simple question, if you want I can do with the solution only. So first in the books of entity B. You can say entity B, first they purchased the building on 1st April 2001. The journal entry will be property, plant and equipment account debit to bank 525. Then depreciation journal entry, depreciation account debit to accumulated depreciation, or you can say building. Correct now. Depreciation to building 2525. Then they have sold a building on 1st April 2002. The bank account debit to building and the difference will be transferred to profit or loss. This gain on sale of building. So bank account it has been sold at 600 to building 500 and profit on sale 100. This was the journal entry in the individual financial statement of entity B. Now let us do the journal entry in the separate financial statement of entity A, means parent company. Correct now. So they have purchased on 1/4/2002. The building account debit to bank 600 And then on 600 we need to charge depreciation for the remaining 20 years. So 600 divided by 20, how much it is? 30. It is 30 lakhs. So depreciation account debit to building 30 lakhs. Now in consolidated financial statement, can I say we need to eliminate this profit? We need to eliminate this profit. So what journal entry will do for elimination of profit? Batao. Can I say we need to eliminate this profit on sale of building? So what journal entry will do in the consolidated books of account? So journal entry will what? Profit on sale of building to building. Profit on sale of building to building. So first journal entry you can see profit on sale of building to building. And can I say because of that profit, some excess depreciation was charged by parent company in their separate financial statement. You can see 100 divided by 20. So what is the excess amount of depreciation? That is 5 lakh. So 100 divided by 25 lakh, that become excess depreciation, that need to be also eliminated. So what journal entry will do? Building account debit to depreciation. Depreciation reduce. So building account debit to depreciation, this needs to be eliminated from the consolidated financial statement. Understood? I hope you have understood this point. Correct? Means you can see this is profit of subsidiary company and this is the depreciation of parent company. So if suppose this type of transaction is given in the entire consolidated question, so be careful about that. This profit on sale of building will affect both parent company and NCI, but this depreciation of parent company will affect only parent company. Means this will be adjusted in the retained earning of parent company, and this profit on sale of building will be adjusted in retained earning of parent company and NCI. Got this point? Have you understood? But for this type of question, when they are asking only journal entry, this particular point is not required. Correct? This will be required when you are preparing consolidated balance sheet also. This point have you understood? Yes, sir. Let me come to next question. Next question is very super question, I will say. I will take time on this. So this is a question of consolidation. ISWA Limited hold investment in Vinayak Limited. The draft balance sheet of two entities at 31st March 2004 were as follows. A similar question I have taken in my question bank from GFRS material, and same question is given in RTP. As a similar question has been given in RTP. Correct now. Means in class we have done similar question, not exactly the same question but similar question. Asset, non-current asset, property, plant and equipment, investment, total non-current asset, inventory, trade receivable, cash and cash equivalent, share capital, retained earning, other component of equity, provision, long-term borrowing, deferred tax, trade and other payable, short-term borrowing. Additional information. ISWA Limited investment in Vinayak Limited. On 1st April 2001, ISWA Limited acquired 400 million shares in Vinayak Limited by means of a share exchange of one share in ISWA Limited for every two shares. One for every two acquired in Vinayak Limited. On 1st April 2001, the market value of one shares of ISWA Limited is 7 rupees. Okay. ISWA Limited appointed a professional firm for conducting due diligence for acquisition of Vinayak Limited, the cost of which amounted to rupees 15 million. So again, this is direct cost related to acquisition which will be transferred to PL. ISWA Limited include this acquisition cost in the carrying amount of investment in Vinayak Limited in the draft balance sheet. Can you see this is not correct? Means whatever investment has been given, where is the investment that is overvalued by 15. This is overvalued by 15,000 thousands. So we need to do some adjustment of 15,000 from this. Yes sir. Yes sir. Correct. There has been no change in the carrying amount of this investment in ISWA Limited in on balance sheet since 1st April 2001. There is no change. Apart from this mistake, there is no other point given for the investment. On 1st April 2001, that is the date of acquisition, the individual financial statement of Vinayak Limited showed a falling balance, opening balance of retained earning given, and other component equity given 750 million and 25 millions. The directors of ISWA Limited carried out a fair value exercise to measure the identifiable assets and liability of Vinayak Limited at 1st April 2001. The following matters emerged. Property having a carrying amount of 800 million The land component 350 million and building component 450 million. So you can see 3 plus 450 is 800. Has an estimated fair value of 1000 million. Land component 400 and building component 600. The building component of the property had an estimated useful life of 30 years on 1st April 2001. So you can see the date of acquisition is 1st April 2001 and they have given balance sheet as on 31st March 2004. 31st March 2004. So you can see 234 means it is actually after 3 years. The balance sheet has been given after 3 years. Understood? This unit be careful. Date of acquisition and date of consolidation. Plant and equipment having a carrying value of 600 million has an estimated fair value of 700 million. The estimated remaining useful life of this plant at 1st April 2001 is 4 years. None of this plant and equipment have been disposed of between 1st April 2001 to 31st March 2004. Yes, sir. On 1st April 2001, the notes to the financial statement of Vinayak Limited disclose a contingent liability. On 1st April 2001, the fair value of contingent liability was reliably measured at 30 million. If you remember, as per Ind AS 103, the contingent liability of acquiry will be recognized, can be measured at fair value. Means the recognition of contingent liability of acquiry is not as per Ind AS 37, that is as per Ind AS 103 only. The contingency was resolved in the year ended 31st March 2002 and no payment were required to be made by the Vinayak Limited in respect of this contingent liability. Means this contingency was resolved, means this contingent liability will become zero. Subsequent accounting of this contingent liability will be as per respective Ind AS. The fair value adjustment have not been reflected in the individual financial statement of Vinayak Limited. In the consolidated financial statement, the fair value adjustment will be regarded as a temporary difference for the purpose of computing deferred tax. The rate of deferred tax to apply is 20%. It means we need to calculate DTA and or DTL as at what rate? 20%. The directors of Iswell Limited use the proportion of net asset method when measuring the NCI in Vinayak Limited in the consolidated balance sheet. It means we need to use proportionate share in INA method. Impairment review of goodwill on acquisition of Vinayak Limited. So they have just given the point of impairment also. No impairment of goodwill on acquisition of Vinayak Limited was evident when the review were carried out on 31st March 2002 and 2003. Well, as on 31st March 2002-2003, there was no impairment of goodwill because we know that goodwill annual impairment testing is required. On 31st March 2004, the directors of Iswell Limited carried out a further review and concluded a recoverable amount of net asset of Vinayak Limited at the date was 2000 million. The recoverable amount has been given which will be compared with the carrying amount. Vinayak Limited is regarded as single CGU for the purpose of measuring goodwill of impairment. What they are saying, entire subsidiary will be considered as single CGU in the consolidated financial statement. Then one more point they have given for provision. On 1st April 2003, Iswa Limited completed a construction of non-current asset with an estimated useful life of 20 years. The cost of construction were recognized in property, plant and equipment and depreciated appropriately. Iswa Limited has a legal obligation to restore the site on which the non-current asset is located on 31st March 2043. The estimated cost of restoration work at 31st March 2043 prices is 125 million. So they are saying that the future expenditure is 125 million. The directors of Iswa Limited have made a provision of 6.25 million. What they have done, 125 divided by 20 and they have created a provision of 6.25 million in the draft financial statement. Yes, this is not correct. This is one error that need to be rectified. An appropriate means this should be actually capitalized with the cost price of PP at a present value of future expenditure. Correct now. An appropriate annual discount rate to use any relevant calculation is 6%, and at this rate the present value of rupee 1 payable in 20 years is 31.2 paise. 31.2 paise. Correct now. Prepare consolidated balance sheet of Iswa Limited. Can we start? Means already we have done reading of the question. Can we start? Yes, sir. This is a good question, I will say. So, first we'll do working note number 1. We are doing question number 4. Working note number 1. Calculation of PC. Calculation of PC. Fair value of issued. So they have acquired how many equity shares? They have acquired 400 million shares. We need to convert all the figures in thousands. Correct now? All the figures in thousand. Okay, sir? So 1 million is equal to 10 lakhs. 1 million is equal to 10 lakh. So we can convert it. So can I say it will be how many equity shares? So I am converting into what? Thousands. Correct? Means if you say 1 million is equal to 10 lakhs. So if you convert this, we need to add 30. So on each amount add 30. It will be converted into thousands. Chalega? Into 1 by 2. This is the number of equity shares to be issued. The swap ratio given. And the price per share is given 7. So this will be how much? It will be 14 lakh. So how many shares? It is 2 lakh into 7 is equal to 14 lakh. So PC become 14 lakh. Understood? Then working note number 2 will do fair value adjustment. Fair value adjustment. So we have for this land, building, then we have what? We have plant and equipment, and there is one liability also. Correct? So what is the fair value given as on 1/4/2001? Fair value given in terms of thousand. So it is 4 lakhs. This is 6 lakhs. I have the question with me. Okay. So I am writing from that. I hope you have the question with you. 7 lakh. And this is liability is what? You can see the liability. The fair value is 30 million. It is 30,000. Correct. Then what is the carrying amount as on 1/4/2001? Is also given. It is 350 million. It is 450 million. It is 600 million. It is nil. What is the fair value gain on acquisition date? On acquisition date, it is 50,000. It is 1,50,000. It is 1 lakh, and this is actually fair value loss. So this will be negative, huh? Be careful. This will be negative. Then can you see when you do plus minus additional expense due to additional expense during post acquisition period for additional depreciation, correct now, etc. So what they have given, that what is the useful life of building useful life, how much given is given useful life, remaining useful life is 30. What we'll do for this, we'll do 1,50,000 divide by 30 into 3. So it is 1,50,000 divided by 30 into 3 is 15,000. So 15,000 minus. Similarly, what is the useful life of plant and equipment? They have given 4 years. What you'll do? 1 lakh divided by 4 into 3, that is 75,000. Correct? And they have given the liability. There is no need to pay. Means it has been resolved. So automatically, can you see it will be reversed? This 30,000 will be reversed. So if liability will decrease, that will become a gain. That will become a gain. Correct now. And this will become, what is the net adjustment as on consolidation date 31st March 2004? This is 50,000. This is 1 lakh 50 minus 50, 1 lakh 35,000. This is 25,000 and this is nil. This is the net adjustment on consolidation date. This point have you understood? Correct. Have you understood this? Now working note number 3. We'll prepare statement of net asset. Statement of net assets. Of which company? Of ICAI. Correct? Yes sir? Yes sir. What is the date of acquisition? Date of acquisition. Date of consolidation. Impose, there are two items. One is retained earning. One is other component of equity. The date of acquisition is 1/4/2001. Date of consolidation is 31st March 2004. Can we start with equity share capital? How much equity share capital given? Equity share capital of Acquari means equity share capital of Vinayak Limited. How much given? It is 5 lakhs in thousand. It is 5 lakh and 5 lakh. Now can you give me retained earning opening balance? Retained earning opening balance is also given as an additional information. Is 750 million and 25 million other component equity. We get out of retained earning. It is 7 lakh 50,000 and other component of equity. It is 25,000. What is the closing balance given? Closing balance we can write down from balance sheet. You can see closing balance has been given 10 lakh 50,000 and 50,000. I hope you are understanding. Correct now. We write down 10 lakh 50,000 and what 50,000. So can you give me the difference? Difference is how much? It is 3 lakh and this is what 25,000. Yes sir. This is how much it is coming? It become 5 plus 7. 7 means it is 12 lakh 50 plus 25. It is 12 lakh 75,000. This is 3 lakh. This is 25,000 and this becomes 16 lakh. Correct. Then on this day we'll do fair value adjustment. Fair value adjustment because there is no other adjustment. Dividend paid adjustment is not there. There is no adjustment for abnormal loss. Nothing. No adjustment has been given. Correct. We can do land. So land has been increased by how much? 50,000 and there is no additional depreciation. It will be 50,000. Then building has been increased by how much? 1 lakh 50,000 and there is an additional depreciation of how much? 15,000. It become 1 lakh 35,000. Then there is a plant and equipment. It has been increased by how much? 1 lakh and there is an additional depreciation of 75,000 and this will become 25,000. And there is a liability. The liability increases how much? 30,000. So this will reduce net asset and there is a gain because that will reverse. 30,000 will become gain. It will be added to the post acquisition profit and this will become nil. Understood? Up to this any doubt? Correct. Now can I say, because they have said that this fair value adjustment will be considered as a temporary difference. So whatever increase will become taxable temporary difference. So taxable temporary difference will be how much? Is 50,000 plus 1 lakh 50,000 plus 1 lakh minus 30,000. So 2 lakh 70,000 will become the taxable temporary difference. On this will create DTL. We recognize DTL on 2 lakh 70,000 into 20% is given. The tax rate is 20%. To 20% how much is coming? 54,000. So 54,000 DTL will be recognized on initial recognition of assets and liability. So it has been assumed that there is no difference between carrying amount and fair value. There is no difference between the uh, just carrying amount and the tax base of acquiry. Understood now? What I am saying. So only the difference arises because of this reason. Because of this reason. Understood? So 54,000 and due to these additional expenses The DTL will be reversed during post acquisition period. So how much reversal? It is 15,000 plus 75,000 minus 30,000. So 60,000 got 20%. How much into 20%? So 12,000 will be reversed. So one DTL reverse, DTL reversal will be income, and creation this will be minus and this plus. Understood? So 54 minus 12, how much it is coming? 42,000. So it will be 42,000 negative, 42,000 negative. So this become INA. How much INA batao? It is 12 lakh 75,000 plus 2 lakh 70,000 minus 54,000. This is 14 lakh 91,000. This will be 2 lakh 52,000. This is 25,000. This is 17 lakh 68,000. Have you understood this point? Bolo. Any doubt in this? Have you understood this? Correct. Now we'll do working note number 4. This is very important question and good question also. Is if similar type of questions is asked, till now they have not given this type of question in ICAI study material. So working note number 4. Now we'll do calculation of goodwill or gain on bargain purchase. So what is the purchase consideration? Purchase consideration already we calculated 14 lakh as per working note number 1. NCI, NCI. So can I say they have acquired how many shares? They have acquired 4 lakh shares. Out of 5 lakh shares means this is 80%. So NCI will be 20%. So by using Pasina method they have given to 20% of 14 lakh 91,000. 14 lakh 91,000 is nothing but the fair value of INA on the date of acquisition. Correct now. This will be how much? 14 lakh 91,000 into 20%. It is 2 lakh 98,200. This 2 lakh 98,200. Total become how much? It is 16 lakh 98,200. From this will minus what? Fair value of INA on the date of acquisition. So fair value of INA is what? 14 lakh 91,000. So what is the goodwill? Goodwill on the date of acquisition is as on 1/4/2001. It is how much? 16 lakh 98,200 minus 14 lakh 91,000. It is 2 lakh 7,200. Understood? Correct. Now they have given also a point of impairment loss. So less impairment loss. Less impairment loss. We need to find out the impairment loss. For that we need to do one more working note to working note of 5. And then this will be the carrying amount of goodwill. This will be the carrying amount of goodwill as on 31st March 2004. Understood? So let us now do the working note for impairment loss. Working note number 5. Impairment testing. Impairment testing. Correct. Of CGU. And entire Vinayak Limited is one CGU, one single CGU. Correct now. So can I say in this we write down goodwill, and this testing we are doing on 31st March 2004. Goodwill and other asset, this will become total. Understood? So what is the carrying amount of goodwill? That is 2 lakh 7,200. And what is the other asset as per Sona? So Sona we can say as per Sona it is 17 lakh 68,000. This amount we can take 17 lakh 68,000. So 17 lakh 68,000. So total become what? 17 lakh 68,000. It is 19 lakh 75,200. Now this goodwill is partial goodwill. Now if you remember that whenever we do impairment testing, we should first gross it up so that it become the full goodwill for the purpose of only impairment testing. for the purpose of implementation. Therefore, we recognize unrecognized, will add unrecognized share of NCI in goodwill. So this is 80%. So how much 20%? 2,07,200 divide by 80 into 20. How much? It is 51,800 will be added. 51,800 will be added. This is only grossing up for the purpose of impairment testing. This is a point of India 36. This is a point of India 30. Super question, I will say. Super question. Correct? So it means 2,07,200 plus 51,800. It become how much? 2,59,000. This is 17,68,000. And the total will become how much? 19 lakh 75,200 plus 51,800. It will become 20 lakh 27,000. Yes, sir. This also we have understood. Now this become the carrying amount after grossing up. We'll compare with the recoverable amount, and recoverable amount is given 2000 millions. Is given in the question. So 2000 millions means it become 20 lakh. 20 lakh. So what is the total impairment loss? Can you give me the total impairment loss? The total impairment loss will be 27,000. 27,000, and this will be entirely allocated to goodwill only. It will be entirely allocated to goodwill. Understood? Means nothing has been allocated to INA. This point have you understood? Yes, sir. But can you say out of this 27,000, 80% will belong to what? Parent company, and 20% will belong to NCI. So whatever has not been recognized, can I say it cannot be impaired? So out of 27,000, the impairment loss which is attributable to parent company, which will be attributable to parent company will be 21,600. Understood? Means your impairment loss will be only 21,600. Your impairment loss will be only 21,600. Understood? So whatever has been attributable to parent company, that can be only recognized. Whatever impairment loss which has been attributable to NCI, because that was not recognized, the question of recognizing impairment loss will not arise. Understood? Yes, sir. Correct. So it means impairment loss will be 21,600. Understood? So what will be the carrying amount? Carrying amount will be how much? 2,07,200 minus 21,600 is 1,85,000. 1,85,600. This you have understood? Yes, sir. Correct. Now, last working note. Working note number 6. Working note number 6 will be for other equity and NCI. We have retained earning, we have other component of equity and NCI. First we write on balance. It is a balance we write on as per the balance sheet of parent company. The retained earning is how much, bata? Retained earning is 28 lakh 65,000 and other component equity is 12 lakh 50,000. It is 28 lakh 65,000. It is 12 lakh 50,000. NCI already we calculated, that is 2 lakh 98,200. Understood? Follow. Any doubt? Then can I say, then we'll do what? The from Sona we have calculated what? This profit and this profit. So share of retained earning and share of other equity will transfer. Yes, sir. Madam. The share of profit or loss, retained earning and other equity. It is how much? It is how much? 2 lakh 52,000 into 80%. It is 2 lakh 1,600. So 2 lakh 1,600, and this is 50,400, and other component of equity is how much? it is 25,000. So 25,000 ka 80%, it is 20,000 and 5,000. Correct. And now there is one impairment loss of goodwill. Can I say impairment loss of goodwill will be entirely attributable to parent company? So will be debited to retained earning only. So how much? 21,600. Up to this, any doubt? Now there are some rectification. That rectification need to be also considered. So the one rectification was that, can I say 15,000 was added to investment account which was related to the direct cost of acquisition which should be charged to PL account of parent company. So can I say we'll do reduce investment account and will transfer it to retained earning, means will debit retained earning. So we'll do minus direct cost related to acquisition, that is 15,000. Correct. And now there is one rectification for provision that I need to read once again. What they have given. Let us read the last para of this particular question. You can see on 1st April 2003, they have completed a construction of non-current asset whose estimated useful life is 20 years. And the estimated cost of restoration work is 125 million. The present value is what? 125 into, they have given 31.2 paise is 0.312. So 125 into 0.312. Okay, this becomes 39 in 1000. It is 39,000. Means can I say this much should be capitalized? Correct. But they have transferred 6.25 million to provision account. So provision account should be what? Means of course provisions account should be increased by this two difference amount, and the difference should be adjusted where? The difference should be adjusted in what? I hope you're understanding. The difference should be adjusted. Means let me explain with what? Journal entry. So I am doing one rectification journal entry. Rectification journal entry. So the journal entry on 1/4/2003. Rectification journal entry. Can I say PP will increase by how much? 39,000. Yes, sir. And provision will increase by, can I say we should create a provision of 39,000, but already we have created a provision of 650. So we should increase the provision by how much? 32,750. And the difference will be adjusted because 650 was debited retained earning. Now it will be credited. So to retain earning how much? 6250. This journal entry have you understood? Correct. Then can I say on 31st March 2004, on provision will do unwinding of provisional amount, means will add interest cost. So interest expense account debit to provision, and the rate of interest given how much? The rate of interest given how much? It is given 6%. So we'll calculate at 39,000. 39,000 का 6% how much? बताओ. 39,000 into 6%, that is 2340. 2340. So this 2340 will be also debited retained earning, and then one depreciation will also come. Depreciation will increase due to this rectification. Depreciation to PP. Okay, 39,000 will be depreciated for how many year? 20 year. So divide by 20. So 39,000 divided by 20. How much? 1950. The depreciation will be also adjusted with what? Retained earning. Means retained earning what will come? Can I say minus? Can I say depreciation? How much? 1950. Minus interest expense how much? Interest expense how much? It is 2340. Correct. And plus that creation of provision is wrongly debited to provision wrongly debited to PL, that is 6250, that will be added. Understood. So this become entire correction, and this will be the retained earning. Retained earning will be how much? 2,86,000 plus 201,600 minus 21,600 minus 15,000. This you calculate. This will come, I think, 3 lakh 3,000. Sorry, 30 lakh 31,960. This will be how much? 12 lakh 70,000. And this will be how much? This will be 3 lakh 53,600. This will be the answer. Understood. Now with this you can prepare what? Consolidated balance sheet. I will work out the CBS, the main point. But have you understood this entire thing? Have you understood this? Follow. This particular point, have you understood? Yes, sir. Now let us come to the balance sheet. I'll directly come to the balance sheet. Now balance sheet. You can see balance sheet, property, plant and equipment. What will come? Can you say first so book value plus book value will take? Understood? Then fair value adjustment of land. You can see the fair value adjustment. Directly we can take this amount. Means directly we can take this amount. Fair value adjustment we have done now. So they have done 2 lakh, then minus, we can say 50,000 plus 1 lakh 35,000 plus 25,000 we can take. Yes sir. Yes sir. Then one rectification of 39,000 minus depreciation. So you can see 39,000 minus depreciation they have done. Investment, can I say whatever investment is given from that 14 lakh PC will be removed to minus 14 lakh minus 15,000 will be done. That was the error. Goodwill as per working note will come. Inventory no adjustment. Trade is with no adjustment. Cash and cash with no adjustment. Equity share capital, can I say whatever equity share capital has been issued, whatever equity share capital has been issued, that is already accounted for, so that will not be reflected. You can see the share capital is coming how much? If you can see the share capital is coming how much? Is coming how much? 7 lakh, so that will remain 7 lakh only. Yes sir. Yes sir. Here is a retained earning will be as per working note. Retained earning will be as per working note. Other component equity as per working note. NCI will be as per working note. Provision, can I say provision, whatever is coming in the balance sheet, that will be increased by the interest expense, that will be increased by the interest expense. Understood? Or provision should be 39,000 plus interest expense. Understood? 39,000 plus interest expense. So provision should be 39,000 plus interest expense. Understood? Long term borrowing no adjustment. Deferred tax should be increased by the amount of DTL we created, and DTL we have reversed. So DTL we created, I think we created 54,000 now. How much DTL we created? We created DTL how much? 54,000. To add 54,000 minus 12,000 will do. Understood? Yes sir. Then current liability no adjustment, short term borrowing no adjustment, and balance sheet will tally. Understood? Yes sir. Any doubt? No doubt? Chalo. The last question of the day will take. One more question will take. In days 20. This is very simple question. This does not require any discussion. What they have given, an entity open a new factory and receive at the beginning of the year a government grant of 15,000 in respect of capital equipment of rupees 1 lakh. It depreciate all the plant and machinery at 20% per annum using straight-line method. Assuming that there is a reasonable assurance that conditions to the grant will be fulfilled. For year 1 past necessary journal entry, and so the presentation of the effect of the grant in both balance sheet and SOPL under both methods. There are two methods. Whatever 15,000 grant received can be deducted from the cost price of asset or can be treated as deferred income. The 2 point is there. I think super easy question. So for this, so we can do from the solution only. Can we do from the solution? Yes, sir. Means when the grant is treated as deferred income, the first generate is bank account debit to deferred income 15,000. Then depreciation will be charged on 1 lakh. So you can see The depreciation to accumulate depreciation 20,000. Correct. And uh, proportionate amount will be transferred from deferred income to PL account in the ratio of depreciation only. In the ratio of depreciation. So it means 20% to 20% of 50,000 is 3,000. So we'll say deferred government grant to government grant income that is transferred to PL. Then you can see they have done government grant income to PL and then PL account to depreciation. Presentation in the balance sheet. Can I say in SOP government grant will be taken as a separate income and depreciation will be taken as a separate expense. Understood? In the balance sheet, you can see property, plant, and equipment will come 80,000, and there will be a non-current liability as well as current liability. So 12,000 out of 12,000, 3,000 is going to be amortized within, and balance 1,000 is after 12 months, 9,000 become non-current liability, and 3,000 is current liability. Understood? Then method 2, when the government grant is deducted from the cost price of asset. So once the amount of government grant received, we can pass bank account debit to asset. So bank account debit to government grant and then government grant to plant and machinery. So 15,000 will reduce from 1 lakh, it become 85,000. Now 85,000 will be depreciated at the rate of 20%. So 85,000 into 20%, that become depreciation to accumulated depreciation, that will be transferred to PL. Understood? Then in the SOP only depreciation will come 17,000. Correct. And in the balance sheet only plant and machinery will come, 85,000 minus 17,000, that is 68,000. 85 minus 17, this is the presentation. Understood? So today we have completed question number 1 to question number 5. Now every day I will come, means at the same time I will come, I will take the 5 question every day so that it will not become heavy for you. So 5 question, out of these 5 question, this one consolidation question was very good. That India's 21 question was also good, and business combination was easy. Balance questions were simple only. Correct now, but this time RTP they have given good quality of questions. However, it may be simple, but they have given some different type of question with some modification in the question. So this time RTP, if we think about RTP, so we can understand that if the question also they gave different time, you should be conceptually strong. Okay, sir. Okay, sir. Thank you very much for today. We'll meet tomorrow. Till then, bye bye. Take care. Enjoy your remaining day. Bye bye. One more announcement that already you have the Telegram group. You can ask me any doubt in the Telegram group. So I'll be there for help you, and I have already mentioned one dedicated Telegram for upcoming attempt. So if you want, if you are writing in the coming attempt, join that Telegram dedicated Telegram channel. Understood? Bye bye. Take care. Bye bye.